I mean, indeed, I think Dr. Aino touched on that earlier when he mentioned that the NGX has actually historically worked with organizations like the Fintech Acquisition just to see how we can be more open and be more supportive. Quite clearly, we are positioning ourselves to be supportive of capital formation for the tech sector. And of course, if we compare ourselves with what's happening in other jurisdictions, we can clearly see that technology companies really represent the future. And we feel that the more of these companies that we can attract, it actually supports what one could call our traditional listed companies, because of course, a rising tide lifts all boats. So if we can really grow market capitalization by attracting technology companies, it certainly will support the market growth in general. But one of the things that we've tried to do quite intentionally is rather than just us think about some of the reasons or some of the hindrances for technology companies not coming to the public markets within Nigeria, it was important for us to directly and deliberately engage and actually have frank conversations. And in those conversations, we're able to distill certain areas where there was some opportunities for us to tweak things and to modify things, most especially in our listing rules. The reality is our rules are written by and large, and rightly so, for a certain kind of business and for a certain kind of investor. If we felt that it was important to actually engage and see perhaps there's an opportunity for us to look at specific things. So if I pick a simple example, many of our listing rules require that companies that are listed are profitable. But if you are looking to attract growth and growing and technology companies that are largely in their early stage, I think Dr. Aino mentioned, I think it was Benga that mentioned companies that are around 4 years old. Quite clearly, having a profitability test or a requirement for profitability is a major hindrance to attracting technology companies. So that's something that obviously we're critically looking at and seeing maybe this is something we can find another way of achieving that same metric, as if it were, or even doing it away with it completely if the buy side doesn't particularly care for that. Indeed, our exchange or our business really supports capital formation in between buy side and the issuer side. So it's important that whenever we create solutions for the issuer side and for the founder side in a way that the investor is comfortable with. So we need to balance both sides of that equation. The other area that we've seen is around corporate governance. Our corporate governance requirements may need some modification, and we're very intentional in having conversations with that and seeing how we can tweak things to make it more attractive or more supportive of companies that work that operate in the technology sector. Financial reporting is another way. I mean, we have quarterly financial reports that are IFRS based, and there are many, many good reasons why that exists. But maybe there's an alternative way that we can deal with that, of course, within the context of the legal requirements of the nation, and where there are specific opportunities to modify things on the legal side of things, then we certainly would advocate for that. Indeed, one of the things that we're doing extensively is to give our inputs in the startup bill in such a way that it's more supportive of the broader ecosystem. But if I can switch the lens towards the buy side community, the buy side, the institutional buy side community, and indeed the HNI and retail buy side community within Nigeria also needs some help in valuing these technology companies. I don't think one can look at a traditional business and value it with the same metrics as they would a technology company. So maybe there's an argument that we should create a separate board or a separate subgroup within our market that deals specifically with technology companies so that they can be measured on a like-for-like basis. I don't think if one looks at a cement manufacturing company or a traditional bank, even if you will, on a P multiple basis, and then you compare it with a technology company, having them match like for like may not be the best way to evaluate it. So maybe there's a need for us, and it's something we're looking at very critically, to group our technology companies in their own subsector, on their own sub area within the exchange, such that one can evaluate them on a like-to-like basis. It also speaks on education. We also need to spend some time with, and we have actually done some work in that area, but there's some additional work that we have in the pipeline where the buy-side community can evaluate and measure and value these technology companies in a way that is at least somewhat in line with what global investors look at it, such that from an issuance perspective, value isn't destroyed. So overall, those are some of the things that we're working on. It's more extensive than that. This event indeed is one classic example of us looking to engage lots looking to have frank conversations, and also learning how we can modify things to be more attractive to the technology sector.